providing financial straight talk for those working and enjoying life after work. This is America's financial headquarters.
And one of the things that the market historically does not like is uncertainty. And although now it's a little bit clearer in terms of who's in the White House, who's in Congress, who's in the Senate, and so forth, there's still a lot of uncertainty hanging out there, and specifically as it relates to the talk of the fiscal cliff that our country is facing, and we are creeping up on pretty quick. We've touched on that in prior shows, and we thought it important that given the election is now complete, what are some of the possible fiscal cliff scenarios that we're going to be looking at here in the next 30, 60, 90 days and beyond? There are some very significant issues that we face.
And it's really a combination, not just the fiscal cliff, but it's also the sunset provisions on rolling back to the old tax scenarios, some of the new taxes that are prepared to kick in. I mean, it's just a huge amount. In fact, there was a quote recently that really caught my attention, and in fact, I normally wouldn't read such a thing, but I think it's short enough and it's compelling enough. It's worth a quick reference. The quote says, "The Bush tax cuts expire, the payroll tax holiday expires, the unemployment extension expires, the sequestration, I have a hard time with that word, the sequestration cuts kick in, new affordable care taxes kick in, and all of that is occurring at the stroke of midnight on December 31st. And then for good measure, the debt ceiling expires a month or two later, taxes change dramatically, income taxes go up for everyone who pays, and the estate tax rate soars while the credit or the exemption drops from over $5 million down to just $1 million, 20% of what it had been." And as that quote wraps up, what a colossal mess.
All right, and what a short period of time that the folks who are in charge have to make some changes. So, Mike, I had jotted down 4 potential post-election scenarios that relate to our economy and the market and the fiscal cliff that you just talked about as well. One option is certainly for them to continually do the same thing they've been doing. You and I would refer that as the definition of insanity. Continue to do the same things over and over again, yet expect our results to be different or better. That's clearly not a good choice. Option number 2 is they can kick the can, which is sometimes what gets done in Washington, unfortunately. And by that, I mean they can simply maybe create some kind of a short-term extension. The reality is we are now wrestling with somewhat of a lame duck session for the next few months until the new folks who are elected get in and kind of transition early next year. So one option is just some kind of a short-term solution. I don't think that's certainly not good for our country or our economy, and certainly not good for the market in the short run, because again, the market does not like uncertainty, and that's what we'd be facing. So kicking the can would be an option, but probably not a good one.
Yeah, and if they do it, hopefully they do it for a very short period of time. In fact, we spoke on a previous show about the manifesto that was sent by 80 plus different CEOs and companies to Congress, encouraging them to not sit back on their laurels again.
Yeah, to not to do nothing, and to not even do some type of a short-term solution. Option 3 is some kind of a moderate compromise on a longer-term basis. And then option 4, which is what I believe we need and most in the country would prefer, is some kind of a long-term compromised solution that will address the spending and address the taxes. And there's numerous article and numerous educational information you read over and over again about how it's pretty hard to spend and tax your way out of a recession or a tough economy. So those are 4 potential scenarios, and hopefully the folks in Washington, D.C. Move it forward.
And where the rubber hits the road, Brent, is the fact that, something has to occur. Like you said, if we keep the status quo, business is not going to jump into the next gear. If you look at the fundamentals in the stock market right now, companies are having good earnings, they have great fundamentals, and yet everyone's wondering, how come they're not hiring? How come unemployment is still up there and all these other things? Well, it's because, as you pointed out, business doesn't like uncertainty. The economy doesn't like uncertainty, and the stock market surely doesn't like uncertainty. And with that uncertainty, these companies are stockpiling their dollars, they're sitting on it. I mean, look how low the interest rates are, and yet, the banks still aren't lending anywhere near what they used to. You would think their doors are getting beaten down for people wanting to refinance and everything else. And it's because all these entities are sitting on the cash. They're not willing to go higher. And with higher taxes staring them in the face and all the uncertainty staring them in the face, that's not going to change. They're going to be doing exactly what they're doing now until Congress and the president starts to make some moves.
Right, you're right, Mike. And the same thing holds true with individual investors. I mean, there are stat after stat of the amount of individual investors that are sitting on the sidelines still. And time again, whether it's a consumer or a business owner, you hear them talking about, I'm going to wait till the election is done. It's now done. Now it's, well, I'm going to wait and see how this tax scenario plays out between now and the end of the year, because they have concerns about personal income tax rates, corporate tax rates, dividend tax rates, estate tax rates, and there's going to be a lot of financial planning and scrambling that gets done between now and year end, under the premise that we are going to experience these rollbacks come December 31st. So very difficult challenges.
Because if you're not on the sidelines, if you're currently invested, you know, what a lot of people need to consider right now is scraping off some of their capital gains right now. In other words, making some sales here. Because if you look at where we stand right now, we're at a 15% tax on capital gains. So if you had $50,000 that you invested, and let's just say it grew to $100,000, so there's a $50,000 capital gain in there. If you were to pull that off the table before year end and pay your capital gains tax, that's $50,000 times 15%, or a $7,500 capital gains tax you'd have to pay. If you waited until next year, under the current scenario, you're going to see the capital gains tax go from 15% up to 20%. Plus, we have the extra 3.8% tax tacked on for the new health care.
That's right.
So now that $50,000 of capital gain that you've enjoyed, when you apply the capital gains tax, you're going to be paying $11,900 instead of $7,500. That's a $4,400 difference. In other words, in 2013, you'd be paying 59% more tax on those same investment dollars than you would have in 2012.
Great point, Mike. So whether you're dealing with a highly investable personal investment or asset, or a business or a piece of property, now would be a good time to seek out some professional help. I would encourage everybody listening to go to the financialhq.com website, search out some information, maybe make a contact with us, and we can connect you with a local HQ advisor. These are difficult scenarios and challenges, and time is of the essence.
Yeah, it's like we always say, plan first, invest second.